Thank you, Liam, and good morning, everybody. And it is so nice to be with you guys, at least virtually, although I'm carrying with me what our colleagues from Australia gave me in preparation for this Congress many years ago. I still have it, and I was planning to take it with me to Sydney. Unfortunately, I couldn't make the conference in person, so here I am. So let me start by my presentation, and I will take it from here. With due respect to the audience, I just want to give a small background of really healthcare within the social protection concept. For many, many years, the World Bank and even the ILO, they have talked about the different pillars under social protection, and they identified pillar 1, pillar 2, and pillar 3. And in these pillars, they were not talking about healthcare. And only about 10, 15 years ago, maybe a little bit more, the World Bank reconsidered their grouping of social protection. And remember, there is something called healthcare. And they remember there is a group of people that they were being overlooked. So they introduced pillar 0 and pillar 4, and without changing the names of pillar 1, 2, and 3. So pillar 0 introduced a new group of people, which are the disadvantaged people and people that are uninsurable. And then they introduced pillar 4 to discuss benefit other than pension. So this is really the pillar systems that they talk about social protection. And here we look at, since I'm a health actuary myself, I thought this is really disrespectful for the health specialists. So we introduced a new system which is talking about healthcare pillars. And then in these healthcare pillars, we talked about who benefits, who pays, and what are they benefit for. And if you notice that when we are talking about the payment, we highlight very much that healthcare is not only pay-as-you-go system, but really it should be funded partially or fully the way we do with pension. And this is a new concept that the World Bank did not talk about pre-funding of healthcare after retirement. And here I want to mention that there were many employers, especially in America and maybe in other countries as well, provided healthcare after retirement for their employees. And after the population matured and people start going up to retirement, they realize that this kind of benefit is too expensive, and they start buying out this benefit out of the active people to tell them, wait a minute, you can drop out of this employment, and this is a big lump sum. And unfortunately, many people did not know that employers are finding the way out the easy way. In Lebanon, for example, one of the major employer, which is an airline with 4,000 employees, barely had any retirees when they introduced that healthcare after retirement. And then when people start retiring, they realize that this will gonna bankrupt the company. The benefits are by far more expensive than they thought about it. And they start giving this people option, and they introduced healthcare after retirement in the national scheme just to get rid of that liability that the employer has. So this is where I have to make some kind of comparison between pension and healthcare, because unfortunately, for almost 100 years, there are pension actuaries, and people are used to what we are referred to defined benefit plans and so on and so forth. And if you remember also, if I want to divert a little bit, even the defined benefit plans in many countries employers are trying to get rid out of that liability, and they are moving into defined contribution because they think defined benefit is very, very difficult to quantify the cost. What is the salary in the future of somebody, and what is the investment return, and so on and so forth, and of course, life expectancy and the effect of pension. So if they think defined benefit is complicated, they should know that healthcare is even more complicated. And here I want to say, because there is a new player, and a new kid on the block, which is the health provider. Again, I would like to talk about a small phrase that is common in America that says, when you are healthy, you don't shop. When you are ill, you don't care. And it doesn't stop right there. The statement goes, and the provider knows that, and they take advantage of that. And this is why I asked Elena earlier, what about instead of 191? And when he becomes 65, the amount grows faster, and so on and so forth. And if we bring what is his salary today, and assuming his salary of 6,000, and the salary is growing to 9,000, and so on and so forth, we will realize that as a percentage of salary, initially speaking, we are fine. So if the group is age 45 today, 2% of salary may be sufficient to cover them. But when the groups start aging, like our colleague Lena just mentioned, if the proportion of the two groups initially was 30% and 70%, and became 50 and 50 and so forth, that weight will change. And we know on a national level, we have aging populations, and the number of the fertility is decreasing, and the life expectancy is increasing. With this kind of balancing, we will realize that the cost of healthcare for the elderly is by far increasing faster than anything else. And this, the only way we can mitigate this is by introducing some kind of free funding to equilibrize, or fully funded, but most likely partially funded, to provide this. And when we are talking about this, it's very important to say what kind of benefit we are going to promise in the future, because we are pricing something that we don't know. We say we want to provide healthcare, but as also our colleague earlier mentioned, that there are new things. We are seeing babies needing liver transplant that we didn't see before. So there are many issues in the future we don't know. And this is why I named, we have defined benefit, DB. We have defined contribution, DC. And I'm saying healthcare is undefined benefit, so it's UB. So it's a new thing that we have to bear in mind. And this is where I'm saying social protection have lived, or the current social protection system that we have outlived its lifespan. Social securities are, the way it is being handled, they are overlooking the most important thing. Earlier this morning, we had a session by Stephen Spiegel and talked about the survey they have done and concern of people. And we were debating with Dr. Edward about reform and the difficulty of reform and the miscommunication. People are unaware of what are the risks of the future and the cost of the risk. And here I mentioned earlier in that session that unfortunately the ILO and WHO talks about human right, healthcare under human right. And this is, for me, the cheap talk. It's very easy to say that, but Dr. Edward mentioned, and he took his wallet out of his pocket. He said, it depends upon the size of the wallet. I mean, what is a human right? Who's going to pay for it? So this is so correct. And I would like to conclude my presentation, and I'd be more than happy to take any questions. Thank you very much.
Okay, thank you, Ibrahim. Very interesting. Maybe if I can invite anyone watching, if they'd like to put any questions into the chat room, that would be appreciated. Maybe if I can just ask you as a kickoff, just probably a more an understanding thing. What was the basis for why medical inflation, you're showing that slide where at a 45-year-old, it was 0, higher at young and higher at the old age. What's the reason for that inflection, just out of interest?
Actually, I don't know the reason, but I know the data. We have the database out of the German health system, and we monitored, we looked at the data of people, the average cost of every subgroups over the years, and the average cost of that subgroup, different, I mean, the same group brackets, we realized that the average cost is increasing. So we assume if the cost is increasing, it should be, usually we say medical inflation, and usually as a rule of thumb, is faster than the overall inflation in a country. So if in a country, the inflation is 3%, and we know that there's a basket of many items, healthcare is usually 30% of the average. But we were very surprised when we looked at the average inflation by groups. We realized that it is increasing, which is mind-boggling, and this is why we start looking at it. And even if we make it equal, still we will have a major increase in healthcare after retirement.
It's interesting to me why it would go down and up. I mean, almost suggesting that medical costs are cross-subsidizing by age. Otherwise, you would expect medical inflation to be a constant increase across all ages always. So, yeah. Thank you.
Maybe certain age groups are aware, they are healthier, they are needing less, but this is the database that we have looked at, I think 10 years or 15 years of data.
Yeah, okay. So
this scale we show, this is on top of inflation. This is on top of inflation.
Right. Oh, it's the excess above. Gotcha. So it's just, yeah.
That's right. This is in excess of inflation. That's right.
Okay. Just another question, maybe if I can ask you. I mean, obviously around the world, there's all the different countries have different models, and we spoke with Lena earlier about, South Africa, some countries in Europe, of course, and Australia, having the community rated models. How do consumers in countries where they don't have a mandatory health system, how do they tend to fund their healthcare and retirement? What's the current model that you've obviously seen a number of countries in this analysis? What's the alternative if you have a mandatory model where you're cross-subsidizing old and young?
There is, in many countries, when they don't even say that they have universal health, the Ministry of Health is the main provider of healthcare, and it's being financed by tax. But most of in these countries, the service is low, is bad. So there are rooms for a private health providers, and the minute we have a private health providers, then we have out-of-pocket expenses, and this encourage private insurance companies to come and pick up the tab. So there are many countries where the Ministry of Health claims that we provide healthcare to all, but really they provide lousy healthcare to all. So this is why the private healthcare provider have a role to play, and unfortunately, there is no control on the pricing exactly, and barely control on the quality as well. So national health scheme is a problem, and as we know that this is a big issue in the States. And in this morning, there were discussions about 3 main indicators about health systems. And I remember very well, they talked about the importance of increase in life expectancy. That means it means the healthcare in that country is good. Per capita GDP, percentage of the GDP expenses, that's very good. And then they talked about a decrease in fertility, infant mortality. The lower decrease in infant mortality, it means the healthcare system is very good. My contribution during that session was I would like to see a correlation between these issues, because there are countries where the expenditure, per capita expenditure is low, however, the health system is good. And we have countries, for example, in East Africa, when there was a big endowment donation by the Canadian government to lower the infant mortality in several East African countries. And after a few years, everybody rejoiced. They were able to bring the infant mortality by 50%. It's still higher than the world's average, but by far less than it used to be. And everybody celebrated. Unfortunately, nobody realized and correlated that we have more beggars on the street. And then we have a child mortality higher, because infant mortality is dying between age day 1 and 1 year.
Explain what happened.
Child mortality is between 1 year and 5 years. Yeah. So we, as actuaries, I think we have the obligations to bring this to light to policymakers.
Yeah, very interesting. Ibrahim, I'm sorry to pause you because we ran out of time, but thank you very much for the presentation. Very, very interesting. And I think that wraps up the rest of the session. And thank you to everyone who's joined today.
Thank you very much. Have a good day. Bye.